If you are a Canadian taxpayer and have more than $100,000 foreign assets, this video is for you. In this video, I'm going to talk about the CRA's foreign income reporting, or commonly known as T1135 reporting, why CRA wants to know your foreign assets, what's the penalty if you miss this reporting, what is the deadline for reporting, a recent case study where a taxpayer paid thousands of dollars in penalty, a detailed analysis of what assets you have to report and what are the threshold for these reporting, a quick walkthrough to an actual T1135 form, and some remedies if you missed those previous year's reporting. Now, why does CRA wants to know your foreign assets? The reason for that is, as a Canadian taxpayer, we have to report our worldwide income. If you make money in Canada, for example, through employment, and you get a T4 or investment accounts where your bank will send a copy of those investment gains and losses or dividend, and they send it to CRA, CRA already knows what assets you have in Canada. But it becomes very challenging for CRA if the assets are located outside of Canada. For example, you might have a foreign rental property in Asia or any other foreign country, and CRA doesn't have any idea how much money you made on those rental income. It helps CRAs to mitigate some tax evasion and make sure that all Canadian taxpayers are going through the same fairness system. Now, CRA has a number of ways for reporting different types of assets. For example, if you are a beneficiary of a foreign trust, you are supposed to report that in a different set of reporting. Now, CRA has a number of different reporting mechanisms to capture those foreign transactions. Now, what happens if somebody does not report their foreign income and assets on T1135? The CRA puts up $25 per day, $2,500 per year for failing to comply or failing to report. Now, if I have a foreign asset and I report it to T1135, does it impact my tax return? Actually, T1135 is just a reporting. It does not change your tax owing or how much tax you are paying to CRA. Remember, if you have a foreign income, you are already supposed to report that to your actual tax return. By disclosing this information to T1135, you are not actually changing your tax liabilities. You're just reporting that you have foreign assets and you are disclosing it to the CRA. The reason why CRA wants to know is to track. So if in future, if you miss, then they can backtrack and back check that you reported some assets in the past and whether you are gaining some money from that assets. So by having a track record, CRA will able to track all those foreign income. Now, what happens if you fail to report your foreign assets or foreign income? There is a stiff penalty for failing to comply, meaning that there is a $25 per day for late reporting, up to $2,500 for a particular year. And if you have a number of years, you can imagine that it can add up quickly. On top of that, there is interest payment on that penalty amount. So if you have multiple years where you did not file any reporting and you have interest amount on top of that, you can expect a pretty hefty amount. Now, sometimes people purposefully ignore this reporting. If CRA is able to catch that somebody is purposefully hiding their foreign assets, then there is a steeper penalty which can range $500 to $1,000 per month, up to $12,000 or $25,000, depending on the severity of the negligence. It also allows CRA to extend the reassessment period by 3 years. That means CRA can go back and reassess those tax returns if the taxpayer missed the T1135 return. Now, you can imagine that failing to comply to T1135 return is pretty stiff, and that's why all the tax preparers are always asking this question if you have foreign asset which is more than $100,000. Now, let's take a look at a recent case study where the taxpayer had to pay thousands of dollars in penalty because that person had a bank account at Swiss Bank where the total amount of foreign assets was $431,000. The taxpayer did not report it to CRA for many, many years. All the transactions were done by telephone banking. And when the taxpayer were asked by the judge what was the reason behind that, the taxpayer said that this is because he was going through divorce and he wanted to hide these assets from his former spouse. Now, the judge give a verdict against the taxpayer and say that CRA has all the rights to penalize this client and collect all those unpaid penalties and interest. Now, let's take a look at the reporting deadline. The reporting deadline for this T1135 depends on what type of entity you are. Now, if you are an individual person, depending on whether you are a self-employed person or a regular employee, your deadline will vary. If you are a self-employed person, your deadline is June 15th. If you are a regular employee or a retired person, your deadline is April 30th. Now, for corporation, 6 months after the end of the fiscal years, and for trust, it is 90 days after the end of the trust returns fiscal period. Now, this T1135 can be done through electronic submission or can be printed out and signed and then send it to CRA's designated department. So what triggers a T1135 reporting? On your tax return, did you own or hold specified foreign property where the total cost amount of all such property at any time in 2024 was more than $100,000? Now, there is specifically two aspects that triggers this. So the first is total cost of all of such properties. What does it mean? So let's imagine that you have a rental property where you paid $80,000 to buy that property 5 years ago. Now imagine property has appreciated over the last 5 years and the market value for rental property is $120,000. Do you have to report that rental property on your T1135? The answer is no. Why? Because the original cost of that property is less than $100,000. If you have multiple foreign assets and the total cost of all those foreign assets is over $100,000, then you have to report all of them on your T1135. Imagine that you purchased a property which is $150,000 at the beginning of this year, and by mid-year or later, you sold it for $150,000. That means you didn't make any money, but because you purchased and the cost of your purchase is over $100,000, it will trigger a T1135. That means you have to report that assets on your T1135 reporting. Now, if you have any investment outside of Canada, let's say in foreign company such as Apple, Google, or any other investment outside of Canada, and their cost basis, meaning the money that you paid is more than $100,000, you have to report that on your T1135. This is a very common mistake that we see from a lot of people where they have investment in Canadian brokerage accounts such as Questrade or Wealthsimple or TD Bank, and it's in Canadian bank. What assets do you need to report on T1135? Now, what assets do you have to include in T1135 and what are the excluded assets on that reporting? The first one is obvious. If you have any foreign corporation, for example, if you have investment in Apple, Google, or any other foreign companies, you need to report that on your T1135. The next one is life insurance policy of over $100,000 adjusted cost basis. Some people might have insurance policy where their investment is over $100,000 in whole life policy or universal life policy. That also needs to be added on your reporting. If you have a foreign rental property, that rental company's information is already included in your T776 statement of real estate rental. When you are preparing this report, you can quickly take information from that T776 form. If you have a foreign bank account, let's say you are American living in Canada and you have a bank account with Chase Bank and you have more than $100,000 there, you are supposed to file it on your T1135. A lot of my clients are American living in Canada, and when they move from the US, a lot of them have brokerage account in the US. A lot of Americans who moved from US to Canada, they tend to keep their US address as it is because that's probably their parents' address or any of their family members' address, and they typically do not change, but they are supposed to change that in the country of residence. The Canada-US treaty says that you are supposed to have the brokerage account or the taxable account in the country of residence. The problem happens when somebody has a US brokerage account and there are securities like investment in Apple, Google, or any ETF that are US stock listed. Those are supposed to be added in T1135. The problem is US brokerage accounts do not provide you simplified statement. It takes hours and hours to calculate those investment manually, and it can drive up your accounting cost. So if you are an American, make sure to transfer your US brokerage account to Canada, which simplifies your process and these reporting requirement. Now the last one is a big one and very common one which triggers T1135 is if you have a large foreign investment in a Canadian financial institution. Let's say you have an account with Wealthsimple, TD Bank, or CIBC Bank, and you have a non-registered account with a cost basis of over $100,000, you are supposed to report that in your T1135. The good thing is all the financial institution knows the requirement for T1135, and normally when you receive T5008 form, you also receive a detailed reporting of those foreign assets. All you have to do is just add all those assets by country and then add that to your T1135. So if you have investment in Google, Apple, or Alibaba, you need to report those in your T1135. Now make sure that the cost basis is over $100,000 if that is the only foreign assets you have. And you have to check each of those months because each of those months, if any of those months you had more than $100,000 book value, then that triggers T1135. Now let's take a look at what are those excluded assets from these T1135. The first one is your personal use property. So you might have a foreign vacation home or your inheritance home, and you typically use those for your personal use. You don't have to report that in your T1135. Now, sometimes people rent out those property. The way CRA looks at it is if you use that property for more than 50% of that time, then it is personal use property. And that will determine whether you need to report on your T1135 or not. If you have rental income, you are supposed to add that to your T776 form and income on your tax return. But if you are using it personally majority of the time, then it does not need to be added on your T1135. Now, what happens to active businesses? If you have property in active businesses, those are reported in somewhere else, and CRA already has those information because when you are filing your business statement, that should be added there, and that's why CRA does not want you to report your active business property in T1135. Any assets you have in your registered accounts are exempt, meaning that if you have foreign investment in RRSP, TFSA, or RESP, or any type of registered account, then you are exempt. That means you do not have to include that in your T1135. If you have a mutual fund or ETF, and that ETF or mutual fund has investment in other country, those does not need to be reported because CRA already has all the information from those mutual fund company and ETF company. Giving individual taxpayer the burden to report those underlying foreign investment would be a nightmare, and CRA does not want you to report that. Also, if you are an American living in Canada, you do not have to report your retirement assets such as IRA, Roth IRA, or 401 types of plan like 401k or 403b or maybe 457 plan. So these are excluded because when you have balance in those accounts, the IRS already knows this information. CRA and IRS always share information back and forth. CRA can easily get that information from the US counterpart. So those assets are also excluded from T1135 reporting. Now, this list does not cover all the included and excluded properties on the T1135. To get the details, you should check the CRS website, which outlines all the assets that you need to report. Now, this is a perfect segue to just quickly go through an actual form to give you some insight of how to fill this form. Now, if you look at the T1135 form, this explains when to use this form. As you can see from the very top, it says the total cost of all foreign specified property has to be more than $100,000. This form will trigger if any time in the year your total cost was more than $100,000. Be careful about those two requirements. Now, if you are preparing an amendment, return, then you have to check this box. But in this case, we are just filing a regular report. You have to identify yourself. So if you are an individual, you will select as individual and it will open up information for your first name, last name, social insurance number, and individual code. Now, if you are a self-employed person, you will select box 1. If you are a non-self-employed person, you would fill out box 2. If you are a corporation, you have to select your corporation and specify your corporate name, business number, and RC number. If you're a trust, you have to also report your trust information. And for partnership, you have to report your partnership number. Now, for all of this, you have to report your address. And if you have a fiscal year, especially for corporation and trust, you have to also specify that fiscal year because this information is required because that will determine the filing deadline for each entity. For example, if you select individual and you select box 1, the system automatically knows that this reporting has a deadline of June 15th. If I select box 2, then the deadline is April 30th. If I select corporation, then I have to specify the fiscal year of the corporation, which will let the system know that this corporation has a deadline for T1135 based on this fiscal year end. Now, if you go to the next section, it will tell you what method you are going to report this. CRA has given you a little bit of relief and made it very simple if your total cost is between $100,000 and $250,000. So that means if the total cost of all foreign property is between 100,000 to 250,000, all you have to do is report this first part A, which is simplified reporting. All you have to do is select the applicable line item here, and then you have to just report all the income. And if you dispose any assets or made some money by selling, then you have to add the capital gain here. Now, if you have more than $250,000, then you have to use part B, which is a detailed reporting method, and that is the second page of the form. It is much more detailed and a lot of information needs to be added. For example, if you have a foreign rental property, you have to add this description, you have to select the country code, what is the maximum cost during that year, what is the year-end cost amount, any gross income, any gain and losses if you sell that property. All those information have to be reported. If you have multiple assets, you have to add a row. Now, if I go back to the first page again, so the first step is to figure out what reporting method you will be using. So first, add up all of the total cost of all of your foreign assets, not just one assets, meaning that if you have, let's say, investment account and you have a foreign rental property, you have to add all of them up. And if the total cost of those assets are over 100,000, but less than 250, then you will use part A reporting. If those are more than 250, then you have to go through the detailed reporting. Let's say somebody has $150,000 investment in Google stock. So Google stock is listed in the US and it's a foreign company to Canada. So you have to select part A because this person only has Google stock. He does not have any other assets. So assuming that, I have to select part A and then I have to select this one and it will open up all the options. So let's say this person has the shares in his Scotiabank iTrade account, and Scotiabank is a Canadian brokerage company. So I have to select that, and it's a Google stock. So I would select USD because that's where the company is listed. So I would select USA. Let's say that Google stock did not give me any income, meaning that it did not provide any dividend. So I would use 0 here. And I did not sell any of those stocks. So there is no gains or loss. Now, if I made any money, I have to add that because this is where I would add the gains and losses. For a client who has only $150,000 foreign assets in Google stock, this is how you report. It's a very straightforward reporting, but it will trigger a lot of information if you have more than $250,000. Let's say somebody has a larger investment account and some rental property in Florida, that will trigger a bigger reporting requirement. Let's say I select part B That way, I have to use the detail method. And let's say I have a Florida property here. So I would list down my Florida property, and then I have to use the USA country code, the total cost, the maximum cost of that year. Oftentimes, these are same. And if I made any money from that rental property. So let's say I have $5,000 gross income. So remember, all this information ask you for gross income. None of them ask you for net income, meaning the CRA wants to know what was the gross rental income before you take any kind of deduction, such as you paid mortgage or you paid a property manager or you had some repairs and maintenance. CRA does not want to know those. CRA just want to know your gross income from those assets. So if you have that Florida property, you have to add that information here. If you sell that property and made some money, let's say you had a gross income of $5,000 and a $30,000 profit, then you have to report both of those information here. If you have a brokerage account with a larger amount and you have all the details information, you will list down the total amount of those foreign assets by country code. So let's say you have some stocks in the US and the USA's code is here. Let's say USA. So what you would do is add up the total cost of all those US stocks here, and then you would select the maximum cost amount during those year, what is the end of the year cost, and if you received any gross income or if you made any gain or loss. Normally your broker statement will have all those information here. All you have to do is just add by country code. So if you have stocks from multiple countries, you have to lump them up and report them separately. So in this case, let's say I have USA stocks and some UK stock. I have to report those total amount by country code. So it's pretty straightforward, and if you need to report those to avoid penalty. And the last section is just to certify that all the information that you are saying is truth and none of those information that you provided are false. So if you are paying somebody to prepare your tax return, they also need to certify and put their information here. If you are not sure about any of this section, there is an instruction sheet at the back of this form which explains all of those information. So you can see here that all those things that needs to be filed are explained here. All those excluded properties that you do not have to report on this sheet are also included here. What are those country code, individual code, partnership code? All those informations are listed on the back of the T1135 instruction sheet. It also shows you where to file a paper return if you cannot do it electronically. As you can see, T1135 is just a reporting mechanism, and you have to report all of your gross foreign income and if you made any gains or losses from those foreign assets. If you have a loss from those foreign assets, you cannot claim those foreign losses against your Canadian gains. And as we looked at, all of those information needs to be on T1135. Now, we already looked at Part A and Part B reporting, and you have to report them by country. Now, let's talk about some special cases which sometimes confuses a lot of people. So now what happens if you are a new immigrant to Canada? Canada has a lot of new immigrant that comes to this country. CRA waives the first year requirement. So meaning that when somebody comes to Canada and it is their first years of tax filing, CRA does not want to give more tasks to these new immigrants, and they do not require you to prepare the T1135. Now, what happens if you are an active investor in the stock market? If your trading business is considered as an active business, all those investment that you are making outside of Canada, you do not have to report them to CRA because those frequent trades can add up pretty quickly, and it will be very onerous for those day traders to report those. So CRA does not want you to report those foreign investment to T1135, but if you make any money on your tax return. Now, what happens if you are inheriting a foreign assets from your parents who live outside of Canada? In those scenarios, when you are receiving those assets, the fair market value of those assets will be your cost basis for your T1135. For example, let's say your parents bought a property long time ago for $20,000 and over time it appreciated all the way up to $300,000 and they passed away. By the time that property got transferred to you, the fair market value of that property is, let's say, $300,000. Because on the date of transfer, the fair market value was more than $100,000, it needs to be reported on T1135. Now, if you are inheriting foreign assets, make sure to use the fair market value on the date of transfer instead of the original cost of your parents. Now, what happens if you are a beneficiary of a trust? Distribution from a foreign trust needs to be added on something called a T1142. Now, we can have a completely separate video for those, but most people do not receive distribution from a foreign trust. But if you are one of those beneficiary where somebody from the USA had a testamentary trust or somebody is paying you from a trust, then you have to report that to T1142. Now, what happens if somebody haven't filed T1135 and they figured out that they need to report all those foreign assets? Now, CRA has a Voluntary Disclosure Program, or VDP, where a taxpayer can voluntarily disclose all those information, and there are some requirements to be eligible for this VDP program. But in most cases, if you are voluntarily disclosing and CRA agrees to your disclosure, then you may not have to pay any penalty or interest. So if you are in a situation like that, make sure to talk to a professional who will be able to help you in that scenario. In extreme cases where CRA decline you the VDB program, there is a separate option where you can ask for a taxpayer relief program. But again, in those circumstances, you need to engage a tax professional who understand all these little nuances and guide you through this complicated process. I'm not a CPA, so don't take my words for granted and contact a licensed professional. So if you have any further question about T1135, please make sure to check out the CRS website. If you like this video so far, please make sure to give a thumbs up and subscribe to our channel. This will help us with the YouTube algorithm and grow our channel. Thank you so much and see you in the next video.